This is the Daily Market Rundown live from the Tradelo trading floor. It's July the 8th. Some highlights from today's show. Tariff threatens with higher tariffs, US yield set to drift higher, and risk markets remain range bound. Good day traders, and welcome to the Daily Market Rundown. Let's get stuck straight into it. A number of things going on. I think the key thing that's very, very important, that sticks out a little bit like a sore thumb, is that both Asia and Europe are up on the day. Now, why does that matter? Well, yesterday we of course know that President Trump raised the bar in terms of the tariff situation, and yet coming into today we can see that particularly the likes of the South Korean index, as well as of course the Japanese index, have taken back most of those losses they posted yesterday. And I think that's the key takeaway. That's the theme. Right now, the taco trade is well and truly alive. So let's get stuck straight into it and talk a little bit about what's going on the tariff front. Now, the key takeaway, of course, is that I'm not going to go through this. You can go and read up about this. But we know that the two key big nations, Japan and South Korea, were threatened with what is effectively the Liberation Day tariffs. Okay, that's what you need to know. Effectively, they've not been negotiating hard enough. And so Trump has used them to set an example to say, look, you've got till the 1st of August to get your ducks in a row. You need to come with us, or to us with concessions. Otherwise, you are getting the Liberation Day tariffs that he threatened back in April. Now, again, those amounts, of course, for Japan is 24% and South Korea is 25%. The market has looked straight through it. That's the key takeaway. The market has looked at this as it's nothing more than what we got early in the year, where they threaten to get the concessions, but ultimately what they will get is something a lot closer to the 10%. Okay, that's the way the market's assessed it. It is not a risk as far as the market is concerned. Now, that's important to frame it that way because there are a couple of shorts in the market, and we will talk a little bit about the pain trade in a couple of slides time. There you can see, of course, the index. We can see the TOPIX is up, 0.17 on the day. The KOSPI up call it 2% up on the day. Now again, the TOPIX perhaps not performing as well, and there's perhaps a little bit more reason for that, and we'll get onto that chart in a minute. But it's got to do with what's going on in the steepening in the yield curve in Japan, and of course we do have an important election cycle coming up. So that's the sort of the base case. Now, I think what is key, and this is going to be something to watch out for from a headline perspective, is what goes on within Europe. Okay, right now there's a lot of positive rhetoric around Europe. Europe was not sent a letter, and the thinking is because they didn't get a letter, we are getting close to some form of a deal. Now, again, what I will stress is that India was supposed to be the first ones to get a deal, and this was, over a month ago. So the point is just because the rhetoric sounds positive doesn't mean that we are going to get something positive, okay? What I think you do have to pay attention to is if we get something negative from Europe, if for whatever reason Trump says, hey, Europe, I'm just going to put a number down and send you a letter because you're not acting in good faith, you can assume that Europe is going to get very close to the 20%, if not the same 20% treatment that they got on Liberation Day. Now, again, we also know there was a retaliatory number thrown out there of 50%. So the key is that if the negotiations don't go well with Europe, then and only then we may get some decent sell-off, some risk-off. Why? Well, because the European Union is, of course, the US's biggest trade partner. Okay, and if things are not going well there, when they are telling us that things are going well and they're nearing a deal where Europe will get the 10% baseline, the reality is the market may start to take a little bit of fright from that. But until then, things are as positive as they can be. Okay, the markets are going to keep moving on the big beautiful bill. They're going to keep moving on ultimately a lot of the policies that are coming in the pipeline, which are pro-growth. Okay, now with that in mind, I think an interesting chart to pay attention to given the tariff situation is break-evens. There's a couple of surveys that went out over the weekend starting to talk about how businesses are going to pass on the higher tariff situation. I think the general consensus with these surveys is that because we are getting this prolonged delay of the tariff situation where there's a high degree of uncertainty, ultimately the general thinking is that inflation could stay higher for a lot longer than what anyone wants. Okay, now keep in mind President Trump wants Powell to cut immediately. The Fed is saying we want to first understand the nature of the tariffs, and then the administration is saying, well, we're not sure what the tariffs are going to be, and so we'll just keep kicking the can down the road. So all of this uncertainty does point perhaps to a scenario where we may not even get rate cuts from the Fed this year. Now, of course, a lot can happen between now and then, and of course we do have two very important inflation prints coming out next week and of course in the month of August, so a lot can happen between now and then, but that's the general thinking from the surveys. Now, in terms of the break-evens, okay, we can see now the break-evens are starting to actually price in a little bit of a higher inflation regime. Okay, now we're not anywhere near where we were in Feb, of course, this year, and of course we're nowhere near the highs made last year around that 275, but we are elevated. Okay, the Fed is not going to be cutting when break-evens are moving higher. They're also going to be cutting when break-evens are moving lower. Okay, so very, very important. Whilst break-evens are not necessarily unanchored, they are moving in a direction that suggests the Fed is not going to be cutting anytime soon. And of course, we do need to find out a little bit more about the tariff situation. Okay. There again, you have that grid that I posted yesterday. Like I said, you can of course see both Japan and South Korea were given the reciprocal tariffs they were given on Liberation Day. The general thinking is that the EU is going to get 10%. That's what we know right now. That's the base case, is that they are negotiating very hard and we will get the 10%. However, I want to stress there are a number of politicians in Europe that are stressing that ultimately they won't accept a bad deal and they will be ready to retaliate. Okay, so it's not that it's a foregone conclusion, but right now if there is a headline, it's going to be to the negative side, to the downside as opposed to the positive side. Okay, that being said, should it come out that the EU reaches a deal, okay, that will be taken very positively by the market, because if the EU can reach a deal, which is the US's biggest trade partner, it means that everyone else can reach a deal. Okay, we of course had this scenario with the UK a couple of weeks back and the markets took it quite positively, and the UK is a relatively small trading partner in comparison to the EU. Okay, so should the EU get a deal today, tomorrow, the next day, guess what? We're going back to record highs and we're going to do it pretty darn fast. Okay, because then the market's going to say, well, look, if the EU gets 10%, everyone gets 10%, and that is a positive scenario for the markets. Okay, let's then move on and talk a little bit about what's going on in Japan, because I think it does matter. Yields are spiking again. There's a number of things going on in Japan, but the key takeaway is it's this rate of change. Okay, you can see for some period of time we did absolutely nothing, but the illiquid conditions that we had, sort of in May, we also had them in April. We're starting to see them again. Now, again, it doesn't seem like that matters for broad markets. They don't seem to care too much. We can see, like I showed you earlier, the topics flat on the day. So perhaps more sort of country-specific implications for now. And I will obviously, of course, show you that in terms of the yen, we can see the yen is down across the board today. Okay, so the yen is getting sold on this, which is a very similar play to what we saw earlier in the year, where US yields were spiking, and as a result, investors sold the dollar. We saw it in the UK. When the UK yields were spiking, they sold the pound. So now we're seeing that same sort of playbook here, which is if we're going to see this steepen, if we're going to see back-end yields sell off very aggressively, they are in actually, in fact, going to sell the Japanese yen. And we can see, Euro yen is up 0.6 on the day. That's quite a significant move. We can see the Swiss is obviously up 0.2 and the yen is down 0.22. So we can see that flows are moving out of Japan as a result of these high yields. So keep an eye on that. Should we get back up to that 320 level or perhaps spike beyond that, you do want to be very aggressively selling that yen against all of its major crosses. Okay. In terms of the rest of the bond space, again, we did see this play out earlier this year when the Japanese yield curve was steepening. Every other bond market steepened. Okay, and that's what I think you want to pay attention to here. You can see the UK curve is steepening, you can see the Japanese yield curve is steepening, and of course you can see the US yield curve is steepening. All the bond curves are steepening, and again, this doesn't necessarily have any implications right now. It's always about the rate of change for yield, so it's pretty much a nothing burger. It's interesting, but it's not to say that it's going to have any implications for any other markets other than the bond markets. Okay, and that's where our play of the day comes from. It's all about the rates play today, and I think that's where the opportunity scope is. This is the weekly 30-year chart in the United States, And finally, you can see we've broken that series of weekly highs. Okay, we had 5 lower highs on the weekly 30-year. I do suspect now we are not only going to just get our way back up to that 5%, but even beyond. Okay, I think we're going to test 510 perhaps at some point this month. So this is the play of the day, perhaps a trade that you will need to take over a couple of sessions. But right now, it looks like long end yields are going to move higher over the course as we move into next week's CPI data. So keep an eye on that. I think that is very much a decent play for high yields. We can, of course, also see when we look at the 230 curve, we can see that now is starting to steepen as well. And I do suspect we're going to make a new high for this cycle in just a couple of days' time. Okay, then moving across to the equity markets, another one of our play of the day is very much the S&P 500. Look, the pain trade is higher. Okay, everyone's looking at this chart going, oh my goodness, it's just gone up in a straight line. Surely it's going to have a pullback, and it just doesn't pull back. Surely it's going to have a pullback, and it just doesn't pull back. Okay, the reality is that we came into this year, every investor was expecting double-digit returns for the S&P 500. We had a little bit of a shakeout trade at the start of the year with the tariff situation. But right now, if we just go and sort of mark out where we were at the start of the year, we were sitting around that 6,100. Okay, so we're not that far up on the year. You know, call it 2.5% in the S&P 500. We are, of course, at record highs. We are in price discovery mode. We are making 52-week highs. Yes, we are potentially overbought, and what that does mean is we're perhaps going to sit in this range between 62, call it 25, and record highs. We might just sit there for the rest of this week, but the path of least resistance is very much the upside. Okay, I think given the news flow yesterday, given a little bit of negative sentiment, there are some shorts in the market, and so I do think one of the key plays today is for a little bit of a short squeeze back up to that record highs. We do also have quite a bit of negative gamma sitting above the overnight high session, so don't be surprised to see a little bit of a short squeeze into last week's highs at some point today. And I think that's very much the play of the day, is just to look for a trade back up to last week's highs and just accept the fact that we are in summer markets. Ultimately, money managers got a very tough job to do now because they have to buy into this rally. Otherwise, they are going to miss out on perhaps what is to come over the next couple of days and weeks. Now, with that in mind, you know, how I think money managers are assessing this is they're looking at what are the risks ultimately looking forward. And if we go and have a look at the implied vol curve moving forward, you can see there's not a great deal. The markets aren't really afraid of anything. Okay, sure, we have got the CPI out next week, and that is a risk event. But beyond that, should that number come out in line, perhaps should it miss, it's just going to add fuel to this rally in the equity space. Okay, so it's a risk, but there are very few risks now that could derail ultimately the S&P 500. And of course, unless there is a recession, unless there's a sudden nosedive in the hard data, which isn't really expected, the path of least resistance is very much to the upside. Now, with that in mind, of course, looking at the VIX, it does confirm the play today for a squeeze. I do expect that VIX is going to come in and fill that gap from July 4th through a long weekend. So don't be surprised to see the VIX, move its way back down to 16.25, and at the same time, the S&P 500 make its way back up to record highs. Okay, so it's a straightforward day today. I think it's going to be low volumes, typical summer trading, but I do think there's some work to do in the equity space and definitely some work to do in the bond space. So we are looking for steeper curves, higher yields in the long end and the back end. We are looking for, of course, higher equity prices, but ultimately you do need to pick those spots, pick those levels. But the path of least resistance is for higher yields and, of course, higher equity prices. If there are any other questions, there is no real economic data today, so if there are any other questions, do post them in the Discord channel. Otherwise, don't be afraid to comment in the description. Otherwise, good luck out there, manage the risk, go make some money.